Welcome back to The Explainer. Okay, we've got a lot of ground to cover, so let's dive right in. Today we're breaking down a really fascinating and frankly urgent analysis from Professor Jiang Xueqin. We're looking at why the next economic slowdown probably won't look anything like previous crises, and exactly how distant conflicts in the Middle East are directly threatening everyday American wallets. We're going to explore why America's economy might be facing some intense new pressure from inflation, interest rates, consumer debt, and even a shifting housing market. Most importantly, we'll talk about why you really need to understand these risks before making your next financial decision.
You know, when we watch the news about the renewed confrontation between the United States and Iran, it's so easy to get totally captivated by the visible threats, right? The missiles, the drones, the explosions on the screen. But Professor Jiang makes a really compelling point. The real danger here is actually invisible. The absolute most powerful weapon in this conflict isn't a missile at all. It's uncertainty. Uncertainty about shipping lanes and energy facilities can travel thousands of miles without ever crossing a battlefield. And where does it land? Right on your grocery bill, your mortgage, and your retirement account.
To make sense of all this, here is our roadmap for today. Number 1, the hidden war tax. Number 2, the cost of military power. 3, strategic realities. 4, 3 future economic scenarios. 5, warning signals. And finally, number 6, the bottom line.
Okay, let's start with Section 1, the hidden war tax, from the Gulf to your grocery bill.
To really grasp the economics of this, we first have to understand the psychology driving the conflict. Right now, the US and Iran are caught in what strategists call a commitment trap. Basically, this is a situation where both sides believe that backing down is going to damage their credibility way more than just fighting it out. The US feels it absolutely must enforce freedom of navigation in the Persian Gulf, while Iran feels it has to impose costs for those US restrictions. So both sides just keep demonstrating their resolve. But here's the catch. When two powers constantly flex their muscles like that, it doesn't always lead to deterrence. It usually leads to escalation. They're essentially fighting over who gets to write the rules for one of the most vital waterways on the planet.
And that psychological trap, it builds into a really harsh economic reality. Think of it like a butterfly effect of inflation. A dangerous Strait of Hormuz basically acts like a slow, confusing tax on the entire global economy. Step 1, insurance companies don't wait around for a ship to sink. They just instantly hike up the premiums for Gulf shipping. Step 2, that extra cost is passed straight to energy buyers and refineries. Step 3, manufacturers, airlines, and farmers end up paying more for that energy. And Step 4, households foot the final bill. This military risk transforms into thousands of tiny price increases everywhere. For working families, this hidden war tax means taking on more consumer debt just to cover the basics. And for retirees on fixed incomes, it eats away at their lifelong savings because costs are rising way faster than their income.
Moving right along to Section 2, the cost of military power, ammunition, interest rates, and opportunity.
So the crucial takeaway here is that weapons cost money, and debt matters. A lot. Professor Jiang brings up this really fascinating historical parallel, the 1956 Suez Crisis. Back then, Britain and France had massive, overwhelming military advantages over Egypt. But guess what? It didn't matter. The financial pressure and the sudden vulnerability of the British pound literally forced them to shut down their operation entirely. The lesson is super stark. Financial systems and debt can place strict limits on military power. Today, the US is carrying a massive national debt, and just paying the interest is eating up a huge chunk of federal resources. Trying to fund a widening conflict means borrowing even more money during a period of inflation, which seriously boxes in America's strategic options. Because of this lingering inflation risk, the Federal Reserve gets backed into a corner. They're forced to keep interest rates higher for longer. And this intense financial strain actually splits the stock market right down the middle. On one side, you have your potential winners, defense companies landing new contracts, energy producers, and gold. But on the flip side, you have highly vulnerable sectors. We're talking airlines dealing with spiked fuel costs, and very crucially, tech stocks and bonds. When interest rates stay high, the future profits of those heavily valued tech companies suddenly look a lot less appealing. Plus, bond yields rise, which pressures prices. So the uncertainty of war doesn't hit the market evenly at all.
All right, let's pivot to Section 3, strategic realities, the island illusion, and regional trust.
You'll sometimes hear analysts suggest the US should just swoop in and seize an Iranian island to secure the shipping lanes. But that's kind of a dangerous illusion. It's exactly like the difference between buying a house and maintaining one. Sure, the US military definitely has the technical capability to capture an island. That's the purchase. But the maintenance? That's a total nightmare. Defending an island long-term from drones, missiles, and coastal batteries would turn a maritime standoff into a devastating territorial war. Instead of making shipping safer, it would literally make it infinitely more dangerous and expensive.
And remember, military strategy doesn't just happen in a vacuum. As Professor Jiang notes, power isn't only the ability to destroy a target, it's also the ability to persuade others that your use of force is legitimate. The analysis impartially points out that the ongoing civilian suffering in Gaza is heavily shaping regional perceptions of American legitimacy right now. Regardless of where anyone stands politically on this, the reality on the ground is that this perception makes it incredibly tough for Gulf allies to openly support U.S. military operations. Without that regional trust and legitimacy, even tactical military successes are going to face massive strategic resistance.
Which brings us to the core of the analysis in Section 4. 3 future economic scenarios. What happens next?
So let's look at Scenario 1, which the analysis considers the most likely outcome. This isn't some sudden apocalyptic crash. It's more like a prolonged economic slowdown driven by really stubborn financial pressure. In this scenario, the strait remains open, but it's totally unreliable. Insurance and oil prices stay high. Because of this, global inflation declines a lot slower than anyone hopes, which forces the Federal Reserve to delay those interest rate cuts. For you and me, that means prolonged market volatility, expensive gas, a chilled housing market, and a steady, frustrating drain on our savings. Both sides avoid total war, sure, but they just hover right below the threshold of a catastrophe.
But what if that threshold breaks? That brings us to Scenario 2, dangerous escalation. If a major asset gets destroyed or personnel are killed, commercial traffic through the strait is going to drop sharply. Oil prices would spike almost overnight. We'd see severe global inflation, higher bond yields, and likely a major stock market correction. Frankly, this is the worst-case scenario for everyday Americans. Why? Because during a severe inflationary shock, both stocks and bonds can tank at the same time. It creates this totally toxic mix of volatility and inflation that directly threatens the purchasing power of your retirement portfolio. Plus, it could force companies to freeze hiring, putting everyday jobs on the chopping block.
And finally, Scenario 3, a diplomatic pause. This is where mediators step in and actually establish some basic rules for commercial shipping. But make no mistake here, this would be driven entirely by mutual exhaustion, definitely not friendship. If this happens, the oil risk premium drops, insurance costs go down, and central banks finally get the flexibility to cut interest rates. The economy might even pull off a soft landing. Markets get some temporary relief. But, and this is a big but, the underlying distrust in the Middle East remains completely unresolved. It's a bandage, not a cure.
So how are we supposed to know which of these scenarios is actually unfolding? That's Section 5, Warning Signals, what you should watch.
Professor Jiang gives us a really concrete checklist here to help cut through the political noise and just watch the real metrics. Signal 1, commercial shipping. Don't just watch the news clips. Are insurance premiums actually rising? That tells you the real danger level. Signal 2, energy infrastructure. Are physical oil and gas exports legitimately dropping? Signal 3, U.S. weapons procurement. Are we seeing a rush of emergency contracts, signaling that stockpiles are actually getting depleted? And Signal 4, the Federal Reserve's language. Are they out there warning that energy inflation is spreading to the wider economy? These 4 metrics are what actually dictate market realities.
Continuing down that checklist, we have Signal 5, Gulf diplomacy. Are countries privately scrambling to up their defensive preparations, regardless of the PR statements they're making publicly? Signal 6, China. Are they using America's distraction in the Middle East to tactically apply pressure over in Asia? And finally, the most crucial linchpin of all, Signal 7, U.S. domestic politics. Can leaders actually define a clear end-state goal? Are we looking for safer shipping, regime change, or something else entirely? Because without a clearly defined goal, public patience just evaporates and the global economy loses all confidence.
Let's bring this whole thing home with Section 6, the bottom line, connecting the macro to the micro.
At the end of the day, it all comes down to this specific chain of events. It is absolutely vital that we understand this flow. Step 1, a missile gets launched thousands of miles away in the Gulf. Step 2, that instantly raises global shipping and energy costs. Step 3, those higher costs create persistent inflation which corners the Federal Reserve into delaying rate cuts. And Step 4, those high rates and sustained inflation mean your savings, your ability to buy a home, and your retirement account all lose their power. Sure, the missiles might grab the dramatic headlines on the evening news, but it's the economic uncertainty that ultimately hands the bill straight to the American consumer. Which leaves us with this massive looming question pulled straight from the analysis. Will this conflict remain limited, or are the United States and Iran inevitably moving towards a wider regional war? Honestly, your financial future might just depend on the answer to that question. We really want to hear from you on this one. Share your thoughts in the comments below. And if you found this breakdown helpful for understanding the real risks to your paycheck and your savings, make sure to subscribe to @MarketWealthIndia for more structured